Hello everyone, welcome to Finance Studio where financial success begins with knowledge. Have you ever wondered why two people can take the exact same home loan, buy similar houses, and yet one person ends up paying lakhs less than to the bank? Imagine this, you borrow rupees 60 lakh to buy your dream home. 10 years later, you proudly say, "My home loan is finally over." But then you look back and realize you paid nearly rupees 35 lakh extra as interest. Now imagine another borrower with the same loan amount who becomes debt free in almost half the time and saves close to rupees 40 lakh in interest. What did they do differently? The answer is not a higher salary, winning the lottery, or some secret banking trick. It comes down to understanding how home loans actually work. Today, I want to talk you through a simple but powerful strategy that can help you repay a 10-year home loan in around 5 years and potentially save lakhs of rupees in interest. If you have a home loan or planning to take one or know someone who is paying EMIs every month, this information could be extremely valuable. Let's start with a simple example. Suppose you buy an apartment in any place and take a home loan of rupees 30 lakh. Let us assume an interest rate of 8.5%, which is around the range many borrowers may receive in the year 2026 depending on their credit profile and lender. If you choose a tenure of 10 years, your EMI will be approximately rupees 37,200 per month. Most people stop their calculation here. They think, I can afford rupees 37,200 every month, so the loan is manageable. But this is where many borrowers make a mistake. A home loan is not just about the EMI. It's about the total amount you will eventually repay. Over 10 years, your total repayment could be around rupees 44.6 lakh. That means for a rupees 30 lakh loan, you may pay nearly rupees 14.6 lakh as interest. Think about that for a moment. You borrowed rupees 30 lakh but may end up returning nearly rupees 45 lakh. This is why understanding the mechanics of a loan is very important. Now let us talk about something most banks never explain in detail: how EMIs actually work. Many people believe that every EMI equally reduces the loan amount, but that's not how the system is designed. In the beginning, most of your EMI goes toward paying interest. Only a smaller portion reduces the principal. For example, during the first month of rupees 30 lakh loan at 8.5%, more than rupees 21,000 of your EMI may go toward interest alone. The remaining amount reduces the actual loan balance. This is why many borrowers feel frustrated after paying EMIs for 2 or 3 years. They have paid lakhs of rupees to the bank, yet their outstanding loan amount has not reduced as much they expected. The reason is simple. In the early years, the bank collects a large portion of its interest. This brings us to a very important concept called the breakeven point. The breakeven point is not an official banking term, but it's a useful way to think about your loan journey. It's the stage where a large portion of your EMI starts reducing the principal instead of mostly paying interest. In simple words, during the first few years, the bank is making most of its money from your loan. Later, more of your EMI starts working for you. This is why timing matters. If you make extra payments early in the loan period, the impact can be massive. If you make the same payment much later, the benefit is significantly smaller. Now, let's discuss loan tenure because this is another area where borrowers unknowingly lose money. Imagine two people take the same rupees 30 lakh loan. One chooses a 10-year tenure. The other chooses a 20-year tenure because the EMI looks more affordable. The second person may feel happy initially because the EMI is lower, but there is a hidden cost. The longer the loan duration, the more interest the bank earns. A longer tenure often means paying several lakhs more in total interest. This is why reducing your loan tenure whenever financially possible can be one of the most effective wealth building decisions. Now comes the most important part of this video. How can you turn a 10-year loan into a 5-year loan? The answer is prepayment. Prepayment simply means paying extra money toward your loan principal whenever you have surplus cash. This could come from your annual bonus, business profits, incentives, rental income, tax refunds, maturity proceeds, or any unexpected financial gain. Let's assume you continue paying your regular EMI of Rs 37,200. In addition, you decide to make a prepayment of Rs 3 lakh every year. That Rs 3 lakh does not go to your future EMIs. Instead, it directly reduces the principal. As the principal reduces, future interest calculations are based on a smaller amount. This means less interest gets charged. Less interest means a greater portion of future EMIs goes toward principal, and that means the loan gets cleared faster. This creates a powerful snowball effect. Every prepayment reduces future interest. Lower interest accelerates principal repayment. Faster principal repayment shortens the loan tenure. A shorter tenure further reduces total interest. Many borrowers are surprised to discover that consistent annual prepayments can reduce a 10-year loan to around 5 or 6 years depending on the timing and size of the prepayments. More importantly, the total interest savings can be enormous. In some situations, borrowers can save close to Rs 20 lakh compared to simply paying the original schedule for the entire tenure. Now I want to share a practical strategy that many financially successful families follow. Whenever they receive a salary increment, they increase their EMI. For example, if your EMI is Rs 37,200 and you receive a salary hike next year, instead of increasing your lifestyle expenses, consider increasing your EMI by Rs 3,000 or Rs 5,000. Most people will hardly notice this change in their monthly budget, but over several years, it can dramatically shorten the loan tenure. Another strategy is to dedicate a portion of every annual bonus toward loan repayment. Many people use bonuses for gadgets, vacations, or lifestyle upgrades. There is nothing wrong with enjoying your money, but allocating even part of those bonuses toward your home loan can generate long-term financial benefits. Before we conclude, here are few important points to remember. Always maintain an emergency fund before making large prepayments. Don't use all your savings to become debt-free faster. Financial security should always come first. Check your lender's prepayment rules and ensure there are no charges or restrictions. Most floating rate home loans in India generally allow prepayments, but always verify the latest terms. Don't ignore retirement investing while focusing on loan repayment. Your future financial goals remain important. And finally, remember that the best time to make prepayments is during the early years of the loan because that is when interest costs are highest. The biggest lesson from today's video is this. A home loan doesn't have to control your future finances for the entire sanctioned tenure. The tenure given by the bank is simply a schedule. You have the power to change that schedule. With discipline, regular prepayments, and smart financial decisions, you can become debt free years earlier than expected and save lakhs of rupees that would otherwise go toward interest. Every rupee you save in interest is money that stays with your family, helps build wealth, supports your children's future, and moves you closer to financial freedom. If you found this video valuable, please hit the like button, subscribe to the channel, and share this video with someone who is currently paying a home loan. Thank you for watching, and I'll see you in the next video.